Hi, my name is Heather Proctor with Camellia Capital Management. In this video, I want to discuss the nickel market and the short squeeze that took place earlier this year. For those not familiar with the term short squeeze, it's when there's a rapid, unexpected rise in the price of a market. Often the position is with a small number of market participants who want or need to buy back or liquidate their position and are struggling to do so. In this case, I'm referring to the nickel futures market. And on March 8th, the price of nickel rallied over $100,000 a ton on the London Metal Exchange, which I'll refer to as LME from here on out. This is the exchange where buyers and sellers transact base metal futures and have been doing so since 1877. When the price spiked so quickly, it left in particular one large short seller unable to financially cover their losses. It also left the clearinghouses where the buyers and sellers warehouse their positions in a very vulnerable situation. Therefore, the LME made the unprecedented decision to close the exchange. If you look back at a nickel chart, you won't see prices above $55,000 a ton because the LME not only closed the exchange and stopped trading that day, but they also reversed or canceled the trades that had taken place. So those that were long nickel and had sold out for a major profit wound up having to return the money. And on the flip side, the players that were short the market were essentially bailed out by the exchange. And there's a lot of speculation as to why this LME made this decision, which we can dissect at another time. But in this video, let's highlight what got nickel into this predicament in the first place. So, number one, lack of CapEx or capital expenditures in nickel mining and refinement. The price has not kept up with inflation, the cost of labor, land, and infrastructure investment. The returns have not been there to incentivize investors. And if you look at this chart, you can see prices have actually been flat for years prior to this run-up. So supply has not kept up with demand, but this has not been reflected in the futures market. Secondly, the war in Ukraine broke out in late February, and the significance of this is that Russia is the largest producer of nickel in the world. Last and probably most importantly, a firm called Tsingshan was the big short seller of nickel during this market run-up. While Tsingshan is the largest producer of Class 2 nickel, the LME physically backs Class 1 nickel only. And we'll dive into the different classes of nickel and the futures delivery mechanics in a future video, but the main point is Tsingshan could not deliver the physical product to the exchange to offset their futures position. And as the market began to run up, Tsingshan's financial stability came into question, and this was the driving force while the LME halted trading and canceled trades on March 8th. So while this saved Tsingshan from financial ruin, investors who had booked trading profits during this chaotic session were furious, and among them were some of the biggest names on Wall Street. And we'll dive into this subject in further detail in our next video. Camellia is an alternative asset manager with a focus on the commodity investment space. We manage a portfolio of energies, metals, grains, livestock, softs, and ESG-related products on behalf of institutions. So what's the best way to gain nickel exposure and manage the risks such as the short squeeze in your portfolio? And is nickel a good buy at these levels? Stay tuned for future videos in this series on nickel. And if you want to learn more about nickel investing or how to include commodities in your portfolio, please feel free to reach out. Thank you.